FOMC has raised the federal funds rate target by 5.25 percentage points, and we've reduced our securities holdings by more than $1 trillion. Monetary policy is in restrictive territory and putting downward pressure on demand and inflation. The unwinding of pandemic-related supply and demand distortions is playing an important role in the decline in inflation. For example, wage growth has steadily fallen since mid-2022 by most measures, despite continued robust job gains, reflecting a resurgence in labor supply, thanks both to higher labor force participation and a return of immigration to pre-pandemic levels. While the broader supply recovery continues, it's not clear how much more will be achieved by additional supply-side improvements. Going forward, it may be that a greater share of the progress in reducing inflation will have to come from tight monetary policy, restraining the growth of aggregate demand. Turning then to my second question. For many years, it has generally been thought that monetary policy should limit its response to or look through supply shocks to the extent that they are expected to be temporary and idiosyncratic. Many argue as well that in the future, supply disruptions are likely to be more frequent or more persistent than in the decades just before the pandemic. A second question then is what we've learned about this standard looking through approach. The idea that the response to the inflationary effects of supply shocks should be attenuated arises in part from the trade-off presented by those shocks. Supply shocks tend to move prices and employment in opposite directions, whereas monetary policy pushes each in the same direction. Therefore, the response of monetary policy to higher prices stemming from an adverse supply shock should be attenuated because it would otherwise amplify the unwanted decline in employment. In addition, supply shocks have most frequently come from the volatile food and energy categories, and they've passed through quickly. While food and energy prices critically affect the budgets of households and businesses, the policy tools of central banks work more slowly than commodity markets move. So responding aggressively to quickly passing price increases could exacerbate macroeconomic volatility without supporting price stability. Our experience since 2020 highlights some limits of this thinking. To begin with, it can be challenging to disentangle supply shocks from demand shocks in real time, and also to determine how long either will persist, particularly in the extraordinary circumstances of the past 3 years. Supply shocks that have a persistent effect on potential output could call for restrictive policy to better align aggregate demand with the suppressed level of aggregate supply. The sequence of shocks to global supply chains experienced from 2020 to 22 suppressed output for a considerable time and actually may have persistently altered global supply dynamics. Such a sequence calls on policymakers to use policy restraint to limit inflationary effects. Policy restraint risk management. Supply shocks that drive inflation high enough for long enough can affect the longer-term inflation expectations of households and businesses. Monetary policy must forthrightly address any risks of a potential de-anchoring of inflation expectations, as well-anchored expectations help bring inflation back to our target. The sharp policy tightening during 2022 likely contributed to keeping inflation expectations well anchored. My third question, then, is the level where interest rates will settle once the effects of the pandemic are truly behind us. By 2019, the general level of nominal interest rates had declined steadily over several decades. As the pandemic arrived, many advanced economies had below target inflation and low or mildly negative rates, raising difficult questions about the efficacy of interest rate policy when constrained by the effective lower bound, or the ELB, as we call it. Over 2 decades, an extensive literature had identified a number of possible changes to the widely used inflation targeting regime, including negative policy rates, nominal income targeting, and various forms of make-up strategies, under which persistent shortfalls in inflation would be followed by a period of inflation running moderately above 2%. Today, inflation and policy rates are elevated, and the effective lower bound is not currently relevant for our policy decisions. But it's far too soon to say whether the monetary policy challenges of the ELB will ultimately turn out to be a thing of the past. The prolonged proximity of interest rates to the ELB was at the heart of the monetary policy review and the changes we made to our framework in 2020. We will begin our next 5-year review in the latter half of 2024 and announce the results about a year later. Among the questions we will consider is the degree to which the structural features of the economy that led to low interest rates in the pre-pandemic period will persist. With time, we will continue to learn from the experience of the past few years and what implications it may hold for monetary policy. These are just 3 of the many questions raised by these challenging times, and of course, we're very far from a complete understanding of the answers. Again, it's great to be here today, and I look forward to our conversation. Thank you.
Thank you very much, Jay, and I think we're really off to an excellent start with your remarks. Let me now turn to Amir. Amir, Israel is a small open economy, faces very specific challenges. Like the US and many other countries, it's seen an increase in inflation in recent years, and the Bank of Israel has been acting on it. In addition, like other small open economies, it faces potential spillovers from monetary policy decisions taken elsewhere by major central banks, with a potential impact on currency and capital flows, and we'd love to hear your views. So, Amir, the floor is yours.
Conference of Ken Rogoff, We all cherish and follow his distinguished contribution in academia and practice. Sort of in a sharp turn, as we're all aware, Israel is currently at a war following the October 7th inhuman brutal attack by the terrorist organization of Hamas. This is a crucial time for Israel's security, and we thank all those who support us. Our hearts are with the innocent victims of the war, and our hope is for it to end with a safe return of hostages and with peace and security. And now I'm going to turn now. I want to turn now to address the issues and questions presented for this session. An important question is, to what extent can a small open economy like Israel, or for that matter, any SOE, conduct its monetary policy independently, or should it rather follow the steps of the major economies? Another question is, what are the spillovers from the policy taken by the major economies to small open economies, and how do those impact local conditions? The answer to these questions depends on the development of the economy, its specific areas of exposure to the global economy, and the particular shock it might need to react to. Generally, local monetary policy cannot be entirely disconnected from that in the major economies. Yet, local circumstances justify and require setting policy that is tailored in accordance with the economy's structure and needs. Key considerations will include interest differentials, foreign exchange, and the effect on domestic activity, in particular exports, and on inflation, and on financial markets. As we all know, our planet has become a small village. The COVID experience demonstrated the spillovers that can result from a common shock. Monetary policy was generally similar in many countries because the initial health shocks, as well as many supply-side difficulties, were similar. Also, we benefited to some extent from the common monetary framework, such as inflation targeting. And that meant that monetary policy in different economies was predicted to act in a similar manner. Having said that, the differential health shock and related steps, fiscal policy differences, and exposure to supply-side effects and commodity prices led to somewhat different policies, consequent inflation, and activity outcomes. Consequently, there was more heterogeneity in monetary policy exiting COVID than upon its entry. Israel was fortunate in that sense, with relatively small share of tourism sector and a relatively large high-tech sector, which actually benefited from the increased dependency on remote work. These circumstances led to a wedge between global monetary policy and the required domestic monetary policy. This slide shows that for these reasons and others, inflation in Israel is in the lowest quartile of rates in the OECD. In particular, headline inflation in Israel was low because its natural gas supply and prices were shielded from global developments. The next slide shows the swift recovery of the Israeli economy from the COVID crisis. The level of GDP exceeded its long-run trend already by the end of 21 and stayed somewhat above this trend by Q3 23. And we'll come back to this recovery ability of the Israeli economy. An additional key attribute in Israel that affects potency and effectiveness of monetary policy is the large share of mortgages that are directly tied to the Bank of Israel. Therefore, raising rates influences the stock of almost all homeowners, not just new ones. This is another cause for possible differences between global and local monetary policy decisions. To respond to the increase in inflation. As a first step, we shrank the unconventional tools employed during COVID, that is QE, FX intervention, and special funding to commercial banks. Relative to its rate of inflation, Israel has been among the first movers. This is another evidence for only partial dependence of SOE on policy taken by major central banks. Here you could see the relative time it took to get into a restrictive zone. The policy the Bank of Israel has in fact set in recent years is consistent with this approach. We are aware of the fact that domestic monetary policy cannot deviate too much from global conditions, but at the same time, we recognize that policy should be set according to specific shocks to our economy, taking into account its fundamental attributes. And you could see over some cycles are shared and some are not. Let me show you some specific shocks. We learned over the years that there is a strong connection between the S&P and NASDAQ indices and the shekel-dollar exchange rate. This is because Israeli institutional investors react continuously to changes in the value of their foreign-denominated portfolio. This slide shows this pattern very clearly. The orange tracks the blue. However, as can easily be seen, since the beginning of 23, this strong connection has weakened. This was the time period that potential changes to the judicial system ignited a widespread civilian opposition. Similarly, the Israeli and U.S. stock markets, who tend to move together, also displayed a weakened connection. According to the assessment done at the bank, if the exchange rate were to follow the NASDAQ the pattern with the NASDAQ index, according to the previous periods, the shekel would have been about 15% stronger relative to the actual foreign exchange rate in September 23. You see it in the gap at the end. Given our estimates of the foreign exchange pass-through to inflation, this amounts to about 1 to 1.5% additional inflation. This demonstrates, again, the power of local significant developments that might have on financial markets, on inflation, and therefore on policy. I want now to move and discuss current developments in relation to monetary policy. An important part in the analysis is, of course, the initial conditions. The Israeli economy is strong and stable. It has robust and healthy economic foundations. We are a global leader in innovation and technology. The Israeli economy has known how to function and to recover from difficult periods in the past and to return to prosperity rapidly. I have no doubt that the same will be the case this time. You could see the growth rate after different military events in the past. Importantly, over the years, Israel has shown responsible fiscal position as demonstrated by the declining path of the debt to GDP ratio. Israel entered the war with a very solid fiscal stand. Our debt to GDP ratio is just under 60%, and a budget deficit which was expected to be 1.5% in 23, following a surplus in 22. There is no doubt the war will have fiscal implications and generate budget pressures. According to initial projections of our research department, which of course, and I cannot emphasize this enough, are accompanied by extreme uncertainty. And assuming the war is primarily concentrated in the southern border and lasts till the end of this year, GDP growth is likely to shrink by about 1% in 23 and 24, and the debt to GDP ratio is likely to rise to somewhat more than 65% by the end of 24, as costs are larger than it was initially projected. As I mentioned in my opening, Israel has been in a war for a month now. Above and beyond the vast human, security, and political consequences, there is no doubt this is a major shock to the economy, to households, workers, and businesses. Economic policy, fiscal, and monetary, which we in the BOI lead, takes the necessary actions in order to alleviate the difficulties accompanying these challenging times. With the outbreak of fighting, significant depreciation pressures were seen, which were reflected in early trading in foreign markets. The Bank of Israel responded rapidly. Already on October 9th, Before trading opened, we implemented a plan to sell up to $30 billion of reserves and to put into operation swap transactions totaling up to $15 billion. Within the framework of the program, the bank is acting in the market to moderate the fluctuations in the value of the shekel and to supply the liquidity required to continue the orderly activity of the markets. The initial high level of the Bank of Israel's foreign exchange reserves at about $200 billion, 40% of GDP, gives us ample space to act to achieve this target. In addition, the bank also put into operation a shekel repo transaction plan and a monetary program focused on small businesses. In parallel, and that's the other side to the approach, from the beginning of the war, the Bank of Israel rapidly formulated a uniform and agreed-upon framework that was adopted by the commercial banks and was expanded to credit card companies as well. The framework is focused on those serving in the Army reserves, the population on the borders, and the families of the victims and hostages. These populations will be able to defer for 3 months payments on mortgages, consumer credit, and small business credit without cost. Many of the banks have extended these steps, a very welcomed outcome, as they are stable, resilient, and have ample capital buffers. In our interest rate meeting on October 23rd, we kept the policy rate at 4.75. This is consistent with the bank foreign exchange activities and inflation endeavors. This array of policy steps that were taken by the bank in the last month reveals the sufficient and necessary independence that the bank enjoys and that it has the adequate set of monetary tools that can ensure financial stability. Avoiding a reduction in the rates is in line with operating in the FX market to moderate large depreciation fluctuations. Moreover, the steps taken by the bank vis-à-vis the banking sector allow in practice some monetary easing, but targeted at those who need it most, without compromising the need to deal with increased risk premia in financial market. Let me say, 1 month in, we can cautiously say that the policy mix we applied contributed to the stability not only of the FX market, but also had positive spillovers for the stability of local financial markets. The developments in the markets also indicate that the public understands that the BOI enjoys the required independence in order to take the necessary steps at these times. Inflation expectations, as you can see in the slides, for the short term and the long terms have remained substantially stable and are stating that we will be back in the inflation target. The exchange rate has depreciated a lot, but by now is back to the level prior to the war. Let me, so you could see the red line, this depreciated more than previous military events, but it's now back to where it was. Let me finish here. Fiscal policy is, of course, central and crucial for the
operate when they're trying to make their forecasts about the path of inflation. My second point about what it means for policymaking in this environment is that central banks must be prepared to respond to renewed financial stresses, especially if inflationary pressures persist. So again, there is the last mile that has to be done, but if inflation remains far more stubborn or further it goes up some more because of other shocks, then that will require interest rates to stay even higher for longer or even increase. And we could be then in a situation where you have an inflation problem while at the same time growth is slowing sharply. So that's a stagflationary environment that one could have, and one certainly should not rule that out. In that scenario, again, some of our research has shown that we would have a large number of weak banks that represent about 1/3 of global assets, mostly located in advanced economies and in China. That would be a very difficult place to be in, which is why it's important to prepare in advance. This is the time for strong supervision, robust stress tests, and it's also important for banks to be able to augment their capital buffers at a time when they're making currently very high profits. Banks should also be prepared to quickly access central bank facilities if needed so that we don't have a repeat of an SVB phenomenon. And much more efforts need to be made to address the risks in the non-bank sector. The third point I'd like to make about policy in the current juncture is that policymakers have to be prepared for more cross-border pressures from increased divergence across economies, increased divergence in policies across economies. So let me give you an example. If you compare 10-year yields in China in its own currency to 10-year yields on US treasuries, for the first time, the numbers have flipped around. So we actually have yields in China treasuries, 10-year treasuries are now around slightly less than about close to 2% lower than the yield that you can get on US treasuries. Now, that obviously puts lots of pressure on exchange rates. And so I'm going to conclude with a few thoughts on what it means for a central banker, especially of a smaller open economy, that's facing pressure from weakening currencies in this environment where yields could look very different for a while. This is based, by the way, on a lot of research that we've been doing at the fund. It's called the Integrated Policy Framework. Okay, so first, what does this mean for exchange rate interventions? I think the important thing for central bankers to keep in mind is first that the exchange rate movement is being driven a lot by fundamental shocks. So it is being driven to an important extent by interest rate differentials, which means that in such an environment, exchange rate flexibility has a very important role to play, and it helps you with adjusting. But of course, on the other hand, what can happen is in an environment of heightened uncertainty, you could see exchange rate movements entering zones that then pose a risk in terms of financial stability concerns, especially if you have shallow FX markets. And there's also this risk, which I often hear, that you might have exchange rates going past some psychological thresholds, which then can lead to non-fundamental behavior in these markets. So in this environment, of course, in these specific cases, FX intervention can play a useful role. But this is going to require judgment, and this is the hard part, which is telling apart when is it truly fundamental and when is it non-fundamental for which intervention should happen. I think the basic policy has to be not that the only thing that matters is if you see a sharp movement in the exchange rate. A sharp movement of the exchange rate can truly reflect differences in fundamentals. But it has to be a sharp movement in exchange rate that then interacts with some friction in the economy. And you can see that through, say, deviations in uncovered interest parity or covered interest parity that then tells you that this shock is getting amplified through frictions, for which you certainly interventions can help. And the last bit on FX policy is just to remember that there is no free lunch. Countries have a certain amount of FX reserves. If you use it, deploy it at a time when it's not really needed and prematurely, then that, of course, means that you're going to have less to use when you are in a more difficult period. So with that, I have 30 seconds just to conclude and just to remind everybody in terms of the 3 points I made, which is firstly, the job of bringing down inflation is not done in many countries, and that requires that you to avoid premature easing of monetary policy either through action or through how you communicate. Second, it's important to for central banks to be prepared to respond to renewed financial stresses and also to buffer the financial system. And third, for policymakers to be prepared for more cross-border pressures because of increasing divergences in policy stances across economies. And I'm going to stop there. Thank you.
Thank you, Geeta. And I will now turn to Ken. Now, of course, Ken, your own work, both when you were in policy, but as an academic, over many, many years, you've touched on all of these issues. And I think, as many people have mentioned already today, your both sets of contributions, academic and policy, completely irrigate our own thinking on these matters. And so I think we're very eager to hear your views on all this.
So first I want to thank the IMF for hosting this conference, and particularly this panel, Pierre-Olivier, Amir, Jay, and Geeta, for participating. Jay, I certainly appreciate how valuable your time is, and Amir, I don't know how you found time to come here, but thank you. It is an extraordinarily difficult period, and in terms of shocks. And I know when you're giving the World Economic Outlook, Pierre-Olivier, we probably always say that, but one of the things here, celebrating my 70 years, I've been around the block, and this is pretty bad. I mean, I think you'd have to go back to the 70s to think about a period that really compares to this. And even if you don't encompass the global financial crisis, but just have the pandemic, and I don't know how to say this, apolitically, but the rather radical shifts in U.S. policy from one president to the next, and the various implications of that. The pandemic, war in Ukraine, now war in the Middle East, and this really fragmentation of globalization is really something extraordinary, and is a very difficult period. I think that has implications for a lot of things, for policy, for macroeconomics. However, before I get into that, I want to say, I can think of, there is sort of one silver lining, and I almost hesitate to say it, because if I'm identifying something the IMF seems to have done right, then it may immediately go wrong. But the thing that has surprised me, and it surprised me a lot, is how we've had the pandemic, global recession, rising interest rates, inflation, and we have not had a major emerging market debt crisis. Forgive me, Argentina. We just haven't had it the way that we thought we would. You can go on to other markets. It's really stunning. And, again, we don't know what's around the corner. But I actually would give the IMF a little credit here. And there was all this, for years, talk about the Washington Consensus and the evils of the Washington Consensus. And you may not have followed it, but there were many alternatives, notably the Buenos Aires Consensus between the presidents of Venezuela, Argentina, and Brazil back in the early 2000s, and much praised by many progressive economists. And without going into the details, I would say the way people characterized the Washington Consensus was something of a caricature. It wasn't, it was sort of picking extreme versions of each policy. And yet, if we look at why haven't emerging markets had a financial crisis, it's, in a sense, they've adopted, at least in the macro sphere, and probably particularly in the central banking sphere, some version of the Washington Consensus. Now, one was to have a lot of reserves. That's really not in the Washington Consensus, and the Japan and the Asian economies deserve credit for that. And now everyone's imitated that in a dollarized world, it provides a lot of resilience. But there are certainly other elements. Regulation's gotten a lot better, and I have to say, whenever I had to sit in on meetings about regulation when I was IMF chief economist, I was sort of bored by them. But, you know, actually it's one of those things where you do your homework and it really pays off. For example, forcing banks in emerging markets to match their dollar assets and liabilities, something really important. And not just that, but the knowledge that many emerging market central banks have about what's going on in their economies, the data that they keep track of. Certainly central bank independence, which I'll talk about in a minute much more, that's been an extraordinary development and allowed many of these things to persist. So anyway, that has been a silver lining in a very difficult situation. So I'm going to pick up on a couple topics. I want to start with interest rates, and I'm not going to talk about policy, but just talk about where do we think long-term interest rates are going. I think, like any financial variable, it's actually very hard to know. But I think if you take a very long-term view of long-term real interest rates, and I gave a paper at this conference last year about it, and done other work with Barbara Rossi and Paul Schmelzing, you see that over the long run there is a very gentle decline, but it's much more gentle than we've seen over the last 40 years. And there's been sort of a lot of work trying to rationalize what happened over the last 40 years in terms of demographics, productivity, secular stagnation, that I have always submitted has been overblown. And if you look at these longer periods, it's just, you know, some of what seems like a structural change is just another kind of big shock that comes along. We've had periods where interest rates have been low, periods where real interest rates have been high around this trend. And typically when you see a really big shock, first, like after 2008, where global rates fell, you know, by some measures, up to global 10-year inflation index rates over 3%, you should never have expected that to be permanent. And of course, the same might have been true how much it rises here. It's difficult to tie the trend exactly, but what is certainly true is long-term rates typically are very volatile. That was somewhat masked during, I think, this period, particularly of the zero bound, which the chair of the Fed has talked about, where the central banks just couldn't do anything. And that provided, I think, took away some of the volatility. My own guess is that we'll be looking at significantly higher interest rates, certainly at least like they were a year ago, and I'm talking about forward-looking real interest rates, and perhaps higher for the rest of the decade or more. Again, there's volatility around this, and I'm talking about the long rate, not the short rate. And yeah, I think there are many reasons for this, but one is deglobalization is probably puts upward pressure and fragmentation on interest rates, both in terms of risk premia and in terms of where savings goes. Another thing I have to say, unfortunately, is there's, in addition to the green transition, we are looking at a decade, 2 decades of much higher spending on defense globally. You know, I've been to conferences at the IMF not so long ago. And Olivier knows this, not him as a speaker, but we were jointly organizing one where one of the speakers insisted well, we never have to spend anything on defense again. So, you know, the interest rates are low, everything's a free lunch, and we should take advantage of that. Unfortunately, that was very sanguine, and we're in a more difficult period there. I've mentioned the green transition. Inequality is something which has put probably downward pressure on interest rates, but there's strong pressures in the other direction. Let me say a few words about central bank independence, which I think it has been incredibly important to maintaining stability that we have, and it's something that's become very important worldwide. I have to mention, when I was at the IMF as a very junior economist, I don't know what it's like now, but you were only allowed one chair in your office for you, because who would want to visit you? That was what people said. But I wrote a paper inspired by Paul Volcker on how central bank independence might help with the inflation problem of the day. And I wrote about the original title of the paper had inflation targeting in it, but it has inflation targeting in it and looks at intermediate targets. I will finally also say that I mentioned this morning about how hard it is to get papers published when you're junior. I couldn't get this one published. I submitted it. One place I sent it was to the JP, where Barrow sent it back by return mail saying, look, there's not going to be an institutional solution to this problem. It's a super game. I got it rejected by IMF staff papers at the time. But I think it's certainly something where it's become very successful. I will say that in sort of trying to apply it, you have to have some humility. You can't think there's some rule that just explains everything, your inflation targeting rule, the world changes. And models, let's face it, are particularly bad at turning points. If your model's predicting that tomorrow's going to be sort of like today, we do really well at that in those models. They're very complicated versions of that, but they're all the same. But when you have a big turning point, and we might have a turning point now, because of many factors, it's more difficult. So let me just talk about a few of the pressures on central bank independence today, and it's a fast-moving thing, and so I'm not even sure I'm nearly up to date. But during the zero-bound era, people said, well, you don't have anything to do to central banks, so you should solve inequality, you should solve the environment, you should solve racial justice, and on and on. And you can see this in central banker speeches. I haven't checked Amir's or Jay's, but you can see this. They're under tremendous pressure to address these issues. And people say, well, you can walk and chew gum at the same time. But there's a question of whether they have the instruments to do that. They're regulatory instruments, but they're very second order in most countries. The central bank's not the only one. And the interest rate is a very blunt instrument. We're certainly, it's possible with these inflation, having experienced inflation and these different times, it will change. I cannot overstate these pressures that I just mentioned on central bank independence, so let me give you, give you a couple of data points on this. first of all, a friend of mine retired recently from being the head of research at a regional Fed, I won't name it, wasn't on the East Coast, and said, you know, I was the last one working on monetary policy in my department. You know, we have 9 or 10 people. They work on all these other issues, inequality, the environment, the weather, but they're not working on monetary policy. And I'm sure that's changed, but I don't know. Certainly the other data point I would put is the American Economic Association does a survey every 10 years with pretty similar questions. And okay, I don't always trust surveys, but since this one says something that I want to say, I'm going to cite it. They polled 500 or 600 people at the AEA convention every year. And there were a few questions, but I'll just pick on one. In 2000, they asked, should who should take the lead in short-term stabilization policy, the Federal Reserve or fiscal policy? And in 2000, it was like 75-25 monetary policy. I don't know where the 25 came from, but they had that. And then it flipped in 2020, which is really hard to get your head wrapped around when you think about how political fiscal policy. I mean, look at what's going on in the U.S. right now. I mean, the idea that they're going to be able to perform surgery on the macroeconomy is scary. There are lots of things fiscal policy should do, and there's a big shock. It's different. I have to mention one other question, which I just have time for, that they asked was, should the main goal of the central bank be stabilizing inflation, or, and then they list jobs, which actually isn't the mandate, but a whole bunch of other things. And so in 2000, we'd still had the inflation. Inflation was the answer. Again, it was about 75-25, and it had completely flipped that, well, don't worry about inflation, by 2020. I think that was before we'd hit this turning point, and maybe it'll be different going forward. Anyway, thank you.
Thank you, Ken. That was absolutely terrific, as we expected. So we've not been disappointed. There's been no turning point on that, at least. And as we've seen today, there are some ways in which central banks are asked to do much more than just monetary policy. Let me maybe open it up to the panelists and see if anyone wants to react to the points that have been raised by others before we then take questions from the floor. So anyone wants to? Gita, please.
Amir, if I may, you briefly mentioned about the use of FX intervention. And I said in my speaking points that it's a pretty tricky thing to tell apart when to intervene and when not to. It'd be great to hear from you how you think about that.
I think one lesson that we learned through economic history is that when financial crises intermingle with real crises or other events, you can think of COVID as a health crisis, went into an economic crisis, and through a lot of the work of the Fed, we sort of averted a financial crisis. But we know those are the deepest. Those have a magnifying effect when the two interact, and that's why when this event had started, it was, and we could already see there was a lot of things going on in Asia and other places regarding the shekel. That was the logic. You want to ensure stability. You want to make sure the markets function. You don't target a particular exchange rate, but you want to moderate things such that the markets function. There is liquidity. And that was our goal. And I think, as of now, as I showed you, the exchange rate sort of through events, obviously it's related to the events that are actually happening in Israel as well, but it gave it time. It didn't drift into panic mode. And that was the role of, and still is the role of FX intervention. When you have risk premia go up, that's the number one concern. There are people, when it happened, immediately say you should lower interest rates.
you.